Jack Bogle Project 2. There's a print version of this. Your project has quite a bit of documentation attached, but I'll provide a talking version for the 3 pages attached to your project. Maybe we can even explain some of this a little bit more. Jack Bogle is an interesting guy. Jack Bogle started Vanguard Funds really as a way to help the average investor do well over a lifetime of investing. He also has a lot of advice. This is a lot of his advice boiled down in a very simple form. Number one, he says invest your age in bonds. This isn't a real scientific principle. I didn't work out a formula and come up with this, but this is something easy to follow. So for instance, if you're age 22, you do 22% bonds, 78% stocks. So when you're young, you will generally, over a long term, you'll do better in the stock market than the bond market. And when you're young, you can afford to ride out any risk of a stock market crash. So as you get older, money gets shifted from stocks to bonds. And if you're age 65, well, guess what? 65% bonds, 35% stocks. Even at age 65, you can afford to have some money in the stock market. And if something happens, if the stock market crashes, you can just live off of the bonds, which tend to be a little bit more stable. This formula, it's a self-correcting formula that drives a point across. It's not that scientific. You could start off with this mixture and adjust it every 5 to 10 years or so. It doesn't have to be. If you forget to adjust it 1 year, the sky is not going to fall. And you can even be more in stocks early on. It's just a good idea. The closer you get to retirement, the more you want in bonds to give you enough latitude to ride out a crash. Vanguard is almost entirely index funds. Index fund, there's some sort of preset formula. Depending on the type of the fund. If it's just a generic stock fund, they'll sprinkle the money out over the whole stock market. Stock market goes up, the fund goes up, and vice versa. And it can be done by a computer. A computer program can manage this. And there probably will be a fund manager, but they won't be paid very much because the computer does most of the work. It's a preset formula. If it's an S&P 500 fund, the money just gets distributed evenly across the Standard & Poor's 500 index. If it's a generic stock fund, it's spread across the whole stock market according to some preset formula. Managed funds, there's a fund manager. Who's going to move money in and out of various asset classes. They may be heavily weighted in stocks, or they perceive something's going to happen in the economy, so they move some to bonds or move to real estate, et cetera, et cetera. And even within the stock market, they'll buy and sell stocks based on what they perceive is going to happen in the next year or so. The problem is index funds do better 50% of the time. Managed funds do better 50% of the time. So guess what? It's like flipping a coin. These fund managers really do not do any better than the general market. They may give you the illusion they do. They're generally well educated. They have MBAs from very elite business schools like the Wharton School of Business. They could have engineering degrees from MIT, for instance. But guess what? All that schooling does not give them enough insight to beat the market, okay, as a whole. Another caveat is index funds have very low fees because there's not a person back there working full time. So fee for an index fund may be 0.2%, managed fund maybe 0.75 or even 1%. So these are costlier. If you go through life if one person goes through life buying index funds, another person goes through life buying managed funds with the exact same type of portfolio, and let's suppose two brothers, Bob and Bill. Uh, Bob's going to end up retiring with quite a bit more money than Bill. Bob may have $1.2 million, Bill may have $0.9 million. Okay, where did that extra $300,000 go? It went to the fund manager with a degree from MIT that drives a Maserati. It's that simple. And Jack Bogle's actually done these studies. Uh, Another concept is dollar cost averaging. I explained that in the handout. Let's suppose you have a large pot of money to invest. Your dear Aunt Sally dies and leaves you $250,000. And you're a little bit nervous about putting it all in the stock market at once. And he says, well, what you can do is break it up into chunks, invest part of it, 1/12 of it every month for a year. That kind of evens out the risk. That lessens the risk that you would have put all the money in the market at an absolute high point. It's just called dollar cost averaging, very simple. So you can put 1/12 of the money in every every month for 12 months, or you can spread it out over 2 years, whatever you want. Jack Bogle also says expect 5 to 7% real growth per year in the stock market. If you have a mixture of stocks and bonds, if it's primarily in stocks, you can expect that. Some bonds, the bond portion would be a little bit less. This is a historical reality. The actual value of the asset in dollars will go up, but inflation will eat up some of it. Back during the tech bubble around 2000, a man named Alan Greenspan invented the term irrational exuberance. The stock market was raging, tech funds going up 20, 30, 40% per year. People thought everybody in this country could get rich off of this money tree. Alan Greenspan knew that this is a long-term growth. Occasionally, during periods of prosperity, things get overvalued, and of course, people think that a 20% return will continue forever, but eventually it won't. The asset values of stocks will return to the mean. He said if you're doing some financial planning over 30 to 40 years, just plan on 5 to 7% annual growth. You can forecast on that, and you'll have a pretty safe estimate of what you'll have in retirement. So that's pretty realistic. Don't get carried away. If we have 3 really good years, don't think it will continue, because sooner or later the stock market will lose 20% in a half a year. So, okay, start early. If you invest from age 22 to 62, you can accumulate quite a bit of wealth, even putting away a modest portion of your income. It's not that difficult, actually. If you have a company with a matching 401k, you put in 5%, the company puts in 5%. That gives you 10% of your income going in, which is quite a bit. That'll provide a comfortable retirement if you invest over 40 years. Better than that, if it's in a 401k, it's pre-tax. So if you put $1 in pre-tax, you may only see 65 to 70 cents coming out of your paycheck. So instead of 5%, maybe you're giving up 3.5% in your paycheck. 5% goes in, companies matching funds 5%. So for 3.5% coming out of your paycheck, a full 10% is going into your 401k. And that will accumulate quite a bit. The money you invest from age 22 to 32 will actually be just as important as everything you invest from age 32 to 62. That's how important the effect of compounding over time is. Okay, the longer the period of time, the more it can accumulate. Money, if you put 10% of your income away from age 22 to 32, that in and of itself will be probably half of your retirement right there from those 10 years. Bogle also talks about investing versus speculating. Investing is putting money away consistently, buying income producing assets consistently over a long period of time. So for instance, 10% of my income, I just keep pouring it into the stock market, pouring it in the stock market, do it for 40 years, I've invested. Uh, what exactly is investing? Guess what? I'm giving this money to a company. If a company issues a stock offering, they're selling the company, you're giving them the cash. That company will use that cash to grow the business. Okay, it's nothing ethical or unethical about that. It's just sound business. And the company will grow, they'll employ people who will raise families, et cetera, et cetera. Uh, Speculating, moving money in and out of the market, trying to time the market. There's nothing different from between speculating and gambling. You might as well be sitting around a table gambling with your fellow human beings over what the stock market's going to do. And in the end, over a short period of time, you're really trying to figure out how to get somebody else's money in your pocket. That's what he's saying. Investing, okay, that's a very sound moral thing to do. Speculating, not only that, you can also lose a lot of money. It's kind of a random thing. You may win, you may lose. You're really just, it's nothing more than a dice game that you're playing in a back alley. That's what Bogle says. And he also says, don't time the market. You may think you can time the market, when it's going to go up, when it's going to go down. But if you try this long enough, you'll decide the market has a mind of its own. The forces short-term that control the market are way beyond our comprehension. Some things come out of nowhere. There may be some people that have inside knowledge into what causes short-term price swings, but most of us don't. Investing over a long term is really very simple. In 1984, I started off with a rotary dial phone. It was plastic, a big clunky thing. And I had an AT&T phone service, $30 a month. I made 10 phone calls. Okay, here we are, 30 some years later. And we have this cell phone, still $30. It makes noise, even if I don't ask it to. This should cost, in adjusting for inflation, this should cost $80 to $90, but it only costs $30 a month for a plan. So the cost has gone down, and what do I get out of this? I make hundreds of phone calls, hundreds of texts. If I want to drive through Chicago, that's like a roller derby. I can drive through Chicago. This can tell me the most efficient path through Chicago. I can look up my investments. I can do banking on here. That's what investing does. I invested in AT&T probably as part of my mutual fund portfolio in 1985. I bought a plastic phone that made 10 phone calls. Now it's worth this. That's what investing does. These companies grow, the economy grows, it gets bigger. The companies you buy stock in become bigger, more productive, they make more money. Speculating, nothing more than gambling. Okay, so don't time the market. You'll get frustrated. I did mention in one of the classes, if you like to gamble, the stock market's the place to be, actually. You'll do better gambling and speculating in the stock market, if you must, than you will by speculating in a casino or with lottery tickets. The casino is only going to give you back 90% of your money. Lottery tickets, the state gives you back half. The stock market gives you back 105 to 107% of your money in a year's time. Okay, so it's really rigged for you. It generally returns more. If you like to speculate, if you like to buy and sell stocks, invest 95%, speculate 5%. Okay, you'll learn a lot. You'll lose a lot of money, you'll take a bath, but guess what? That's a good teacher. Okay, that causes you to pay attention. You'll learn all about various sectors of the stock market. You may lose some money doing so, but eventually you'll learn quite a bit about the stock market. So that's my recommendation. Just don't do it with all your money. Try to put all of it in. Well, you may spend 10 years and lose everything if you're on the losing end of all these speculations. So that's Jack Bogle in a nutshell. There actually, I think there's a message board called Bogle Heads. If you Google Bogle Heads, you can actually probably join a group and discuss these things with other people. So We'll be back. We'll have a second video discussing some basic stock information, and then a third video discussing a very simple strategy. Jack Bogle describes a lot of stock information just so you know what you're doing. But there's a very simple strategy you can use to invest over a lifetime. It doesn't take a lot of time. We'll be back for another video shortly.